Welcome to an introduction to consumer-directed healthcare plans and health savings accounts, presented by Access Point HSA and approved by the Society of Human Resource Management for 1 professional development credit. Unless you're brand new to health savings accounts, you probably have a good understanding of what an HSA is, but we'll take a quick look at that now. But before we can talk about the health savings account, we need to mention the high deductible health plan. In order to be eligible to contribute to a health savings account, one needs to be covered under a HSA eligible high deductible health plan. This high deductible health plan is a lower premium plan for 2 reasons. Number one, that higher deductible up front. So you're paying more money up front before the insurance starts to cover claims. Therefore, you have the lower premium. But also, the idea is with consumer-directed healthcare is that because of the additional cost associated with the front side of the plan, you'll be a better consumer of your healthcare. Now, when it comes to that health savings account, it is a tax-favored account that can be used to pay for qualified medical expenses associated with that high deductible health plan on a tax-free basis. The HSA came in 2003 through the Medicare Modernization Act. President Bush signed that bill on December 8, 2003, the Medicare Prescription Drug Improvement and Modernization Act of 2003. Now, if you were to look at the newspaper on December 9, 2003, the big story was not the health savings account. It was the establishment of the Medicare Part D prescription drug program that was part of the Medicare Modernization Act. The HSA was formally established as well at that time. But again, the big change in the Medicare Modernization Act of 2003 was Medicare Part D prescription drug program. And the idea behind this consumer-directed healthcare through the high deductible health plan with the higher deductible and lower premium and the health savings account coupled with that to provide the tax benefit of the HSA in assisting to pay those costs associated with that high deductible, that is to bring in this consumerism into healthcare. It goes back to the old saying from Milton Friedman that nobody spends someone else's money as carefully as he spends his own. Nobody uses someone else's resources as carefully as he uses his own. And we see that with the idea of the high deductible health plan, that when you have a financial stake in the game, you'll be more careful on how you spend your money as opposed to just paying a premium and not having any kind of impact on the usage of your healthcare. So let's take a look at the current state of the HSA market. Devenir's research each year comes out with 2 reports concerning the HSA marketplace. In the last report, the end of 2020, their year-end report, they stated that there were 30.2 million HSA accounts. It's a 6.7% increase in 2020, which is impressive when one thinks of the impact of the pandemic on employment. So still having a 6.7% increase in the number of HSA accounts is still pretty impressive. Devenir also reported that as of December 2020, total HSA assets was $82.2 billion, a 25% year-over-year increase. As you see here, we've seen this strong growth each year. Devenir projects that by the end of 2023, total HSA assets will be $127.5 billion. If you were to look back at recent or in the past at projections made by Devenir, they've been pretty much on target, maybe slightly conservative. So $127.5 billion is a pretty significant increase, but based on Devenir's track record, they're usually pretty accurate. And here's where it's really interesting. People are beginning to understand that the HSA is a powerful long-term retirement planning tool, and that you're able to invest your HSA assets, grow them triple tax-free, and then withdraw them for qualified medical expenses, also tax-free. So we've seen that at the end of 2020, $23.8 billion of total assets is now invested. That's a 52% year-over-year increase. A 52% year-over-year increase. If you look at the prior year, between 2019 and 2020, you saw a similar increase. So the growth in the investment of these HSAs has really been impressive. Devenir projects that by the end of 2023, total investments of HSA assets will be $40.9 billion. And finally, with regards to that Devenir report, 49% of accounts in 2020 saw more money go into the account than was withdrawn. Now, when it comes to average contributions, the average employee contribution was $2,054. The average employer contribution, $870. Now, when you look at the average individual contribution, which would be for an HSA owner that is not an employee, they may be self-employed or they may not be employed at all, and they have an HSA of their own, not through an employer, the average contribution was $2,033. So what is a high deductible health plan? A high deductible health plan must meet the federal guidelines for the floor, the annual deductible, and the ceiling, the out-of-pocket maximum. It must provide certain preventative care services at no cost. And again, high deductible health plan enrollment is a requirement for one to be eligible to contribute to an HSA. If you are familiar with health plans, you may have heard of individual plus one, where it's not really a family plan, it's an individual plus one. There's no such thing with a high deductible health plan. You have if it's more than one person covered under the health plan, it's a family plan. So if it's one person, individual plan, more than one person, it's family plan. This is important because that's going to identify the minimum deductible, the floor, and the out-of-pocket maximum on the ceiling on the plan. In addition, it's also going to dictate how much one can contribute into a HSA associated with that plan. So when it comes to a high deductible health plan, really what's most important to qualify as HSA eligible high deductible health plan is that the floor and ceiling, the floor being the deductible, the ceiling being the out-of-pocket maximum, meets the criteria set by the federal government, and that certain preventative care services be provided at no cost prior to the deductible met. Now, what doesn't matter is the plan design. So you can have a high deductible health plan structured like an HMO, a PPO, or a POS. Now, when we talk about this HMO or the PPO, we're really talking about, do you have to go see a specialist with a referral, or can you go directly with the HMO? You need the referral. With the PPO, you don't. All that doesn't really matter how that plan design is set up. It really, what matters again is the floor and the ceiling. In addition, when it comes to the funding arrangement, an HSA eligible plan can be fully insured, so it's a premium base where the employer is paying a premium to a third party that is providing the insurance, or it could be self-insured where the employer is directly paying all of the claims with the health plan, and they're using that third party as a manager, if you will, to process claims and to get the advantage of their pricing. So that doesn't matter either. So it's important to know what's important and what's not. So regarding the floor and the ceiling that's set for an HSA eligible high deductible health plan, in 2021, the floor, or the minimum deductible, is $1,400 for an individual plan, $2,800 for a family plan. The ceiling, or the maximum out-of-pocket expense, is $7,000 on the individual plan, $14,000 on the family plan. It's important to note that minimum deductibles do not include preventative services. So preventative care services can be provided prior to that deductible being met and the plan still staying HSA eligible. Minimum deductibles and out-of-pocket maximum expenses also do not include the payment of the premium, services that are not covered under that healthcare plan, and possibly out-of-network services may not be counted against these amounts. But again, this is the framework that the government provides to say this is a plan that is HSA eligible. It's based on this minimum deductible and maximum out-of-pocket expense. When it comes to expenses associated with a high deductible health plan, preventative care services can be provided at no cost with the high deductible health plan. And there are some preventative care services that must be provided at no cost. So this created a question of whether or not a high deductible health plan would still be a high deductible health plan if services were provided at no cost prior to the deductible being met. In September 2013, the IRS published Notice 2013-57, which addressed this and said basically that the health plan, a high deductible health plan, does not failed to qualify as a high deductible health plan simply because it provides preventative health services without a deductible. So a high deductible health plan is allowed for preventative care services to be provided at no cost prior to the deductible being met by the policyholder. Here is IRS Notice 2004-23, which shows the safe harbor screening services, preventative care services that can be provided through a high deductible health plan at no cost. Many of the items that you would expect to be on such a list. In the summer of 2019, the federal government expanded the list of screening services that can be made available through a high deductible health plan before the deductible at no cost to the individual. We have a list here. The idea was that there were folks with chronic health issues such as asthma, diabetes, heart issues that would not choose a high deductible health plan because they would have to pay too much money out of pocket with that deductible and never be able to build up a balance in a health savings account. So they expanded this screening services so individuals with chronic health issues such as listed would be more likely to be able to take advantage of some of the benefits of the health savings account and the high deductible health plan. Medications can also be considered preventative care and provided at no cost through the high deductible health plan. Basically, the definition of a preventative care prescription drug or medication is it's taken by a person who's developed the risk factors for a disease but not the disease itself, or to prevent reoccurrence of a disease for which a person has recovered. In addition, there are obesity, weight loss, and tobacco cessation programs that are also available as a preventative care prescription drug through that high deductible health plan. So a good example of a person who is taking a medication because they have a risk factor but not the disease would be taking a statin drug because of high cholesterol. And here on the right, we do see an example of some of the preventative care prescription drugs through the CVS Caremark Preventative Therapy Drug List. This is not a exhaustive list by any means, just some of the items that you might be familiar with, some of the prescriptions you might be familiar with. Let's take a look at the payment structure of a high deductible health plan using the minimum deductible and maximum out-of-pocket expenses for 2021. It's important to note that this is just, again, taking the minimum and maximums that the federal government set up, that floor and the ceiling. Okay, so obviously every plan is going to be different based on how the plan is structured. We're just saying here is the structure provided by the government. We'll use that to take a look at this payment structure. So the first $2,800 is 100% paid by the employee. We'll call the person the employee at this point. So the first $2,800 is paid by the individual or the employee. Now that may not include all expenses because preventative care services can be provided prior to the deductible being met. Now between $2,801 and $14,000, now at that point the health plan is starting to pay claims because that deductible has been met. And again, it's dependent upon the terms of the health plan what the employee is going to be responsible for after the deductible is met. It's going to be co-pays and co-insurance, that percentage of the total cost that the individual has to pay. And again, that'll be based on the health plan. Then at $14,001, at that point, 100% of the claims are paid by the health plan. The employee is not responsible for any of the payments, including co-insurance and co-payments. So regarding deductibles, there's actually two type deductibles. There's an aggregate deductible and an embedded deductible. An aggregate deductible is pretty straightforward. It's one umbrella deductible, if you will, for the plan. So one person could incur 100% of that deductible. An embedded deductible, on the other hand, has an individual deductible for each person underneath that umbrella. It's a better form of coverage, and the fact is one person can't have a major event and bang up right against that deductible. They've got a guardrail for that through this embedded deductible. So the premium would be higher with an embedded deductible, plan with an embedded deductible, than an aggregate deductible. The embedded deductible must at minimum meet the minimum deductible established by the IRS for that family high deductible. We talked about the floor and the ceiling. It has to at least meet for each individual that floor of $2,800. Now, this is by plan design, not by legislation. So this is a choice that employers can make when putting their plans together. According to the Kaiser Family Foundation, in 2020, 17% of HSA eligible high deductible health plans had an embedded deductible. And we'll take a look at this a little more closely to give you a little bit better understanding of what we're talking about. Okay, so here's the first and most common, the aggregate deductible. So we have Dylan and Laura. They're married. They're covered under a family high deductible health plan. They have a $4,000 deductible. It's an aggregate umbrella deductible. So now Dylan incurs $4,000 in medical bills. He pays the entire amount, the $4,000, because the deductible on the plan is $4,000, and there's no embedded deductible to say one individual person can only spend up to a certain amount. So Dylan pays $4,000, the plan pays $0. Going forward, however, the deductible is met, and now the plan will kick in, and then it'll be based on plan design on what Dylan or Laura have to pay. So here we have Dylan and Laura. They're married. They're covered under that family high deductible health plan with a $4,000 deductible. But in this case, the plan also has an embedded or individual deductible of $2,800. Again, $2,800 would be the minimum that embedded deductible could be, because it can't be less than the required minimum deductible set by the IRS. So Dylan has that $4,000 in medical bills. Again, $4,000 deductible, $2,800 embedded deductible. Dylan has the $4,000 bill. If you look at the second row here, Dylan pays $2,800 because that's his maximum deductible. The plan kicks in and pays $1,200. We're just making, to keep it simple, we're not talking about coinsurance. We're just looking at deductible. So $2,800 is paid by Dylan, $1,200 is paid by the plan. Now there's still $1,200 remaining of the aggregate deductible. So if Laura has any claims going forward, the first $1,200 would be the responsibility of Laura under her deductible. If there's any other claims concerning Dylan, he's really just going to pay co-payments or co-insurance because he's met his embedded deductible. Okay, so we can see the additional coverage here with this embedded deductible. So you can assume that a premium on a high deductible health plan with an embedded deductible is going to be slightly higher than that without, because this is really a better form of coverage because of that embedded deductible. So the embedded deductible is by plan design. However, there's another component that is also involved, and that's an embedded out-of-pocket maximum. The out-of-pocket maximum is not by plan design. It's not by choice. It's by legislation. Health plans are required by law to include an embedded out-of-pocket maximum, which is basically saying that an individual's out-of-pocket expenses within a family plan cannot exceed the Affordable Care Act's out-of-pocket limit for an individual plan. So similar to what we just discussed with the deductible, this is saying one person's out-of-pocket expenses cannot go past a certain limit. So one person can't have a catastrophic event that ends up having them meet this out-of-pocket maximum for that healthcare plan. Now in 2021, the maximum out-of-pocket limit for the Affordable Care Act, under the Affordable Care Act legislation, is $8,550. So interestingly, the Affordable Care Act has a higher out-of-pocket expense maximum than the high deductible health plans. We've already talked about what the government set for a high deductible in 2021. It's $7,000 for a family plan high deductible versus you're looking at $8,550 being the maximum for the Affordable Care Act. So at one time, these two out-of-pocket maximums were the same, but there was a different multiplier applied to the Affordable Care Act, and that's the reason they've split apart and the high deductible is actually lower. When it comes to the embedded out-of-pocket maximum, I think this example will clear up things. I'm sure it's confusing at this point based on two different type out-of-pocket maximums. So I think we go through this. This will be helpful. Mary and Raymond covered under a family high deductible. $4,000 is the deductible. 20% is the coinsurance. The out-of-pocket maximum with the plan is $10,000. Okay, so that's the structure of their plan. Mary has a health event that results in total medical expenses of $30,000. So here we have on the left, you see the total expenses, $30,000. The first $4,000 is paid because that's a deductible. That brings you to $26,000. The coinsurance is 20% 20% of the $26,000 that's remaining after the deductible's paid. So that's $5,200. So in this case, Mary's total bill is $9,200. The $4,000 deductible and the $5,200 in coinsurance. But if we look to the right here, we see the on the top again, the $10,000 is the out-of-pocket maximum the plan calls for. Mary's bill on the second row is $9,200. That maximum is $8,550. That's the embedded out-of-pocket maximum allowed in 2021 because that's the maximum with the Affordable Care Act. Mary pays the $8,550. The plan kicks in and pays the additional $650. Now there still is more of the out-of-pocket maximum that could be met, and that's all going to be dependent upon Raymond if he has any expenses such as coinsurance or co-payments. He doesn't have a deductible because the deductible on the plan's already been met. So again, you can see the idea behind this is we don't want one person to be hit with one bill that ends up bringing you right up to that out-of-pocket maximum. That's the reason for that legislation. So when it comes to the traditional versus the high deductible and the plan offerings, who's offering what? And this is the benefit focus study. This is their numbers for 2017, 2018. They looked at larger employers. And as you go down market to the smaller firms, the percentages drop in the percentage of firms that offer a high deductible versus a traditional. But with the larger firms, 70% in 2018, 70% of large employers offered at least the option of the high deductible health plan. You see that in the dark blue, and then the very light blue, you see the 5%. So it's dark blue, 65% in 2018, light blue 5% for a total of 70%, offering at least the option of a high deductible health plan. That lighter blue is full replacement. Only the high deductible health plan is offered. So in most cases, people who are on a high deductible health plan made the choice to go to the high deductible health plan. Most have not been forced into the high deductible because they had no other option. As you see, it's only 5%. According to the benefit focus study in 2018. So most people are given a choice with regards to the type health plan that they have, but what are they choosing? Here we have from the Kaiser Family Foundation a look from 2015 to 2020, 2015 being in the darker blue, of the choices people are made regarding health plan enrollment. And we see that the PPO is the most popular plan. It was at 52% in 2015. It's dropped to 47%. And pretty much most of that drop has gone to the high deductible health plan because the HMO and the POS have dropped themselves as well. So we have seen more involvement with regards to the high deductible health plan, but still the PPO is the most popular plan in the country right now. So the first component we're going to look at with this side-by-side comparison of the PPO and the high deductible is just at the deductible. Here we're taking a look at the average annual deductible for an individual high deductible health plan versus a PPO and a family high deductible versus the family PPO. This is according to the Kaiser Family Foundation. So as you see here, there's a major difference between the two plans when it comes to the deductible, and not surprising based on the name, the high deductible health plan has a higher deductible, $2,300 on the individual versus about $1,200 on the PPO, and about $4,600 versus $2,700 on the family side. If someone just looks at this information here on the deductible, say which one would you prefer? 100 out of 100 people are going to take the PPO, but there's more to the deductible, there's more to the health plan in that decision than just the deductible. So here's the second component that kind of changes the calculus, and that's the annual premium. We've looked at the deductible, now let's look at the annual premium. We have about a 14% difference on the left with the individual high deductible versus the PPO, about $6,900 versus $7,900. With the family high deductible versus the family PPO, it's about a 9% difference, about a $2,000 difference in that annual premium. It's important to keep in mind that when we look at premiums, those are guaranteed savings or guaranteed costs because that premium must be paid. However, with the deductible, that is not guaranteed. That's going to be based on one's usage. So when we look at this comparison, we need to realize that that 14% difference or the 9% difference on the premium is a guarantee, where the deductible is not. We may not ever see the higher deductible. It's all going to depend on the amount of usage of our health plan. Now, when it comes to out-of-pocket expenses, that maximum amount of money that comes out of your pocket through that high deductible, whatever type plan you're on, here we see a comparison with the high deductible. On average, the out-of-pocket expenses are higher than with the PPO, about $3,500 to about $4,300. So when we talk about the minimum deductible and the maximum out of pocket, the floor and the ceiling, as I mentioned before, the floor is typically higher. The out-of-pocket expense maximum is usually lower, and so here we see it with the individual plan. Now with the family plan, the same is true. About $1,000 difference between the family PPO and the family high deductible when it comes to out-of-pocket expenses. Again, on average, the high deductible will have a higher out-of-pocket expense maximum than the PPO. However, there are some plans where it's set up differently, but on average, the high deductible has a higher out-of-pocket maximum. So now I want to take a look at the calculation of plan choices between a PPO and a high deductible health plan using an actual real life example. So if you just look at the high deductible health plan versus the PPO and you simply look at the deductible, you're going to go with the PPO, and it would make sense. But we need to, again, incorporate the idea of the premium savings and along with that high deductible. So here we have an example of a real life offering that's been made with a major a good sized company, I think about 4,000 employees. And here's what they were offering their employees this past year. The high deductible health plan you see in the left in the smaller box, the high deductible had a $3,000 deductible versus only $1,000 with the PPO. The coinsurance, that amount you pay, the percentage you pay after you've met your deductible, is twice as large with the high deductible than the PPO, 20% versus 10%. Out-of-pocket maximum for in-network expenses, $10,000 versus $4,000. So again, a higher out-of-pocket maximum with that high deductible. And the annual premium, a big difference between the high deductible and the PPO, $3,172 with the high deductible, $5,408 with the PPO. For those who are on the high deductible, and again, this is a family plan, the employer is making a contribution of $1,000. So here you see underneath that small box 0, making the assumption, let's say there were no costs incurred during the course of the year, no healthcare cost incurred. We will talk about with high deductibles that preventative care services can be provided at no cost. So let's say there's some preventative care services, but really nothing more than that. So if we take a look at that comparison, it's pretty straightforward. Really what we're doing is we're taking the annual premiums and we're netting out the idea of $1,000 contribution from the employer, and it's a no-brainer, obviously. $5,400 versus about $2,200 with the high deductible health plan. But now let's take that same scenario, the same offering between the high deductible and the PPO, nothing's changed. But now in this case, let's say the individual or the family has $10,000 in medical costs for the year, $10,000. So here on the larger box, we see the $10,000 under the high deductible. The first $3,000 is paid on that high deductible for the deductible, leaving $7,000, of which the individual is responsible for 20% of that amount, $1,400. In addition, obviously, you're having your payroll deduction of your premium, and your employer is making the contribution of $1,000. It nets out to a little less than $6,600. Now, with the PPO, you're only paying $1,000 on that deductible, and you're only paying 10% of the remaining $9,000 after you've paid your deductible. For an additional $900, you pay your $5,400, your $7,300. So again, even at $10,000, you're better off with that high deductible in this case. And you can keep messing with these numbers. It's important to note also when it comes to HSA contributions and such, there's savings associated possibly with payroll taxes and, of course, income tax savings. We're not incorporating any of that in this. We're keeping it pretty straightforward, just looking at the confines of the two plan choices. So again, this is to help you understand the calculation people should be going through in comparing these PPOs versus high deductibles or HMOs versus high deductibles, not simply looking at just the deductible or the out-of-pocket maximum. When we look at enrollment here, looking at the traditional PPO, not surprisingly, the older individuals favor the PPO, the preferred provider organization, that traditional plan, maybe for two reasons. One is it's tough to teach an old dog new tricks. That's what you're used to. That's what you've always had. To move to a high deductible may be difficult. And the second is, in some cases, maybe people are in a position where they have a very heavy medical expense, either because of pharmaceuticals or other reasons, and they just feel more comfortable with that PPO. When we look at the enrollment of a high deductible health plan, however, it's the opposite. It's the younger individuals who take to the high deductible at a higher rate. And if you think about it from the standpoint of a millennial, it makes a lot of sense that you take to this high deductible health plan. On average, your health spend is going to be less than older individuals. That's just common sense. So why do you want to pay a higher premium for insurance you probably aren't going to use? You're basically over-insuring yourself by paying that higher premium, and especially when you couple it with the idea that you may have an employer who's making a contribution into an HSA for you, and that money is portable in that health savings account. It definitely makes sense for younger individuals to be able to take advantage of the premium savings with that high deductible. And then also, as we talk about the HSA, to be able to use that HSA going forward to prepare for costs down the line. One last thing regarding millennials and HSAs, the portability of the HSA is important, I would say, to them, because as we know, the younger generation has moved from job to job more quickly than previous generations. We see this here in a LinkedIn study from 2016. Those college graduates between 2006 2010 worked for close to 3 companies within their first 5 years after graduating, which was higher than previous generations. So, the portability of that HSA, the fact that the employer makes that contribution, puts that into an HSA for you, and you're able to leave to another employer, you take that HSA with you. Now, if you're have the ability to go with a high deductible at the new employer, that's fine. You can continue to contribute. If you don't have that option, they don't offer a high deductible, you still have that HSA. You can still invest that HSA. You can still use that HSA. So portability is definitely another attractive feature of that health savings account to the millennial. This is the final slide that we're going to go through when it comes to the adoption of the high deductible versus the PPO. And this is taking a look at both age and income, bringing those two factors that seem to drive the high deductible enrollment. So here we see for the different ages, moving from left to right, the millennials to the baby boomers and older. If you look in the green, you'll see those are the average salaries for those different age groups. In green, those are the individuals who chose the high deductible versus the PPO. In all cases, you see that those who chose the high deductible on average have a higher annual salary than those who chose the traditional PPO. When it comes to millennials, it's about a $3,000 difference. It's not that great. However, when you start moving out to the other ages, especially the baby boomers, you see a big gap in those who go with that high deductible versus the PPO. Might be a couple answers for this. Number one, when they look at the tax advantages available with that health savings account, that's number one. Number two, when they also look at that deductible, it doesn't scare them as much because they have more income to be able to pay that deductible. So again, age and income are real strong factors in which type plans individuals are choosing. So let's take a look at the major characteristics of the health savings account, starting at 12 o'clock with that orange slice. Tax-free contributions from federal and, in most cases, state tax. So you've got these contributions from the health savings account that right off the bat is saving on the federal and most likely state tax. There's only 2 states that have a income tax that do not allow residents to avoid tax on their HSA contributions. That's California and New Jersey. In addition to the tax-free contributions from federal and state, if contributions are made pre-tax, you're saving on the payroll tax. So that 7.65% at minimum of FICA is also saved if the employer offers the HSA as an option on the 125 cafeteria plan. There's 7.65% at minimum savings on the payroll tax for the individual. And by the way, that also is saved by the employer. So on both sides, no income limits with the HSA. Regardless of your income, you're able to take advantage of the tax benefits of the HSA. Contributions do not have to be from earned income. And in addition to the money going in tax-free, earnings also grow tax-free. So you've got that money going in and growing tax-free through investments or interest. And then it's portable. It is an individual account. That money, once it's deposited into the HSA, is the individual's to do with what they choose, which includes moving the money to another HSA provider because they have better investment options, they like a provider better, or they've left an employer. So a lot of flexibility with that health savings account as well. The HSA is triple tax-free. We hear that a lot. So what exactly is meant by triple tax-free? Any money going into the HSA, contributions into the HSA, are done tax-free, with the exception on the state tax of what we spoke about with regards to Alabama, California, New Jersey on the state tax. But federal tax is always going to be on a tax-free basis. And that doesn't matter whether or not the money comes from an employee, the employer, family member, irrespective of the source. The money goes into the HSA tax-free, grows through interest earned and investment of assets, again tax-free, and then withdrawals for qualified medical expenses, also tax-free. That's the triple tax-free. Money's going to go in tax-free, grow tax-free, come out tax-free, never paid a dollar in tax in that case. Now, if you take money out of an HSA for other purposes prior to turning age 65, for a non-qualified medical expense prior to age 65, you will pay ordinary tax plus a 20% penalty, But at age 65, that 20% penalty goes away. At age 65, it's just you're paying ordinary tax. So with regards to HSA withdrawals, withdrawals for qualified medical expenses are always going to be tax-free. Now, prior to age 65, withdrawals for non-qualified medical expense, the individual pays ordinary tax plus a 20% penalty. At age 65, the HSA really becomes like a 401k on steroids. If you use it for a qualified medical expense, tax-free. If you use it for a non-qualified medical expense for any other purpose, you simply are paying ordinary tax on that dollar amount, just as you would a 401k. Here's a tax treatment comparison of the HSA, the 401k, the IRA, the Roth IRA. When you look at it, in the light blue is a taxable situation. You know, the money's coming out taxed on the 401k. On the Roth, the money goes in taxed. There is a required minimum distribution, as we know, on the 401k, not with the Roth. It's only with that health savings account does the money go in tax-free and comes out on a tax-free basis for a qualified medical expense. And because of that, there's no required minimum distribution with that HSA because Uncle Sam doesn't have any money coming to him unless the individual uses the HSA assets for a non-qualified medical expense. So let's take a look at how an HSA differs from an FSA or an HRA. More people are confused by HSA and a flexible spending account, especially on how they're different, how they're the same. So let's take a side-by-side comparison for 2021. Who can contribute? With an HSA, we've talked about it, anyone can contribute to that HSA, the employer, the employee, even a family member, anyone. With the flexible spending account, it's the employer and the employee as well through payroll deferral. With the HRA, it's just the employer. We talked about the maximum contributions for an HSA, $3,600, $7,200 being the maximum contributions for individual and family, plus a $1,000 catch-up contribution at age 55. We'll look at the flexible spending account, $2,750 or $3,500, depending if it's one person or two spouses. There's really no limit with the HRA. It's important to note that really there's no contribution with the HRA. It's a reimbursement account. When it comes to the ownership of the account, that's where we see some real differences. With that HSA, the individual owns the account. It's their account to take it. That's why they're able to roll it over year and invest it and build it up for, to help pay healthcare costs in retirement or in the future at some point. With the flexible spending account in the HRA, the employer actually owns those accounts. When I say with the flexible spending account, if someone rolls over too much money from one year to the next, that additional money goes to the employer, not the employee. So it is an employer account. Only the HSA allows for investment of assets. And when it comes to ERISA, generally speaking, an HSA is not covered under ERISA. We'll talk about that in a later section of this program. The flexible spending account and the HRA are both covered under ERISA. And when it comes to rollovers, there's no limit to the time, the number of times or the funds that you can roll over with the health savings account. With the flexible spending account, there's a maximum rollover of $550 possible. And with the HRA, again, it's a reimbursement account. It's not really an account that the individual is able to roll over accounts. So I like to say, when we look at this, when we see someone deciding to put money into a flexible spending account, the question they ask is, how much should I contribute? How much should I put into this FSA? Because the concern is, if I put too much in, I'm going to lose some of it. I can't roll it all over. I don't want to lose it. With an HSA, that's not the question at all. It's how much can I put in? Because there's really no limit when it comes to the number of rollovers. So you have no concern. It's your account. There's no concern about losing that money as there is with the flexible spending account. So as we talk about HSA eligibility, we're really speaking about the eligibility to contribute to an HSA, not own an HSA. So someone could have had HSA eligibility to contribute to an HSA, did so, has money in their HSA, for one reason or another is no longer HSA eligible, meaning can't contribute to an HSA. Doesn't mean they close their account and liquidate. They can still use the money for medical expenses. They can still invest the money to grow it going forward. Everything stays in place with the exception of being able to contribute. So when it comes to HSA eligibility, again, it's regarding being able to contribute. You can't be covered by anything but a high deductible health plan. You can't be covered by a spouse's or someone else's non-consumer directed health plan. So you can't have a situation where you have spouses, one spouse has an individual high deductible from their employer and the other has a family plan, PPO, that the other spouse is covered under. That would make the spouse with the individual high deductible ineligible to contribute to an HSA. You can't be claimed as a dependent on someone else's tax return, and you can't be covered by a spouse's or anyone else's general health flexible spending account or health reimbursement arrangement, health reimbursement account. General health flexible spending account, or HRA. We're not speaking about dependent care, flexible spending accounts, or commuter FSAs. We're talking about a general health. That would be considered another form of coverage. So you could have a situation where a husband has an individual high deductible through his employer. The wife has an individual PPO through her employer, and she elects to put $500 into a flexible spending account. That $500 in the flexible spending account, because it could be used for the spouse, makes the spouse with the high deductible health plan ineligible to contribute to an HSA. An individual becomes HSA eligible on the first day of the following month in which they meet the HSA requirements, and therefore when they lose eligibility, they remain HSA eligible for the full month, so you don't lose it mid-month. One other definition: a subscriber is the person for who the health plan is purchased, and a member is for the person who's covered under the subscriber's health care plan, if you will. That matters later on as we talk about Medicare. So again, HSA eligibility, the ability to contribute to an HSA, you cannot be covered under a general health flexible spending account or health reimbursement arrangement, health reimbursement account, whichever you want to call it. So a flexible spending account or HRA, FSA, general health is considered to be another form of coverage. You're not eligible to contribute to an HSA. If you're covered under TRICARE, you have coverage under TRICARE, you're not eligible to contribute to an HSA. Now, if someone has an injury from service, is going to the vets for specifically assistance with that injury, that's not considered a full form of health coverage. But if you have your health coverage through TRICARE, which is for military service members, you're ineligible to contribute to an HSA. If you're covered under any part of Medicare, even if it's Part A, which doesn't have a premium, you're ineligible to contribute to a health savings account. Now, a couple of wrinkles to this. If it's a limited purpose flexible spending account, or HRA, so it can only be used for vision or dental, that is acceptable. You can continue to contribute to an HSA. If it's a post-deductible flexible spending account, or HRA, meaning the money can only be used after you've met your deductible on your health plan, that would not make you ineligible to contribute to an HSA. A retirement HRA that's available during retirement, that would not make one ineligible to contribute to an HSA. And concierge medicine, which is where an individual pays a doctor or practice an additional dollar amount for preferred service and access to that doctor or patient, is not considered to be another form of health coverage. So someone could participate in concierge medicine with a doctor or firm and still contribute to an HSA. Now, concierge medicine is not a qualified medical expense, but it wouldn't prohibit you from contributing to an HSA. Moving from a flexible spending account to a health savings account is cumbersome and clunky at best. So employees cannot participate in a general health flexible spending account and contribute to an HSA, just like we said. Most flexible spending accounts run on a calendar year and basically do not allow for mid-year changes. Okay, so here we have in the dark blue, we have an example, and this was a real life example of someone who went through the CHSA training program about a year ago. Had a client who was in this exact situation and brought it to our attention. We helped them with it. National company offers its employees a general purpose health flexible spending account as an option for the calendar year 2018. The company later switches all their employees mid-year from a PPO to a high deductible health plan. Well, the problem is that those employees who elected to participate in the general health flexible spending account are ineligible to contribute to the HSA until at least January 1, 2019. And the reason, again, is because they're covered under this, they have money in this flexible spending account, and that's for the entire plan year. So they're not going to be eligible until at the earliest, the first day of the following year. So let's take a little closer look at the movement from a flexible spending account into an HSA when it comes to eligibility. This concludes our program. Thank you for taking this course. Here is your SHRM activity ID number that you'll be able to use to submit to SHRM for your continuing education credits for this course.